When I was a teenager, I got sick and had to stay home from school the week of Halloween. One of the TV stations had a marathon of all those classic 80s horror slasher movies. You know the ones I'm talking about, Michael Myers, Friday the 13th, and Freddy Krueger. They all have the same premise. There's a group of teenagers harassed by a killer who has long knives, short knives, or even knives for fingers. And it doesn't matter if the kids run, fight back, or alert authorities, he just keeps coming. And even when they finally finish him off at the end of the movie and you think everything's over, there's a sequel. This is how I'm feeling about inflation this year. It just won't go away. And I'm sure many of you feel the same. I'm Jeremy Reed with Advent Partners, and thanks for tuning in for a quick market update. We're about to enter the Halloween season, and so far this year, we've seen the Federal Reserve hike interest rates several times and to greater and greater degrees, and Congress passed bills to smooth supply chains, both in hopes of quelling inflation. But after all that, we still got a sequel last week. Inflation spiked 8.3% year over year and 0.1% over the previous month. Now, 0.1% doesn't sound substantial, but it means that we haven't quite turned the tide on inflation like investors hoped. It also encourages the Federal Reserve to maintain its hawkish stance. The Fed met yesterday and increased rates by 0.75% for the third time in a row. The decision itself wasn't too much of a surprise, but what investors have been waiting for is the Fed's remarks regarding their decision. Despite the interest rate hike decision being the same the last 3 months, markets have responded differently each time due to Chairman Powell's remarks afterwards, whether they're optimistic, pessimistic, or purposefully vague. If we look back to June, markets rallied 17% after that decision into early August on optimistic remarks by Jerome Powell, as energy prices, food prices, and core inflation were declining at the time. In early August, after the July decision, though, Chairman Powell changed his tone and mentioned they were committed to getting inflation back to pre-pandemic levels of 2%, even if there be, and I quote, pain to households and businesses. Those more pessimistic remarks caused a 10% downswing, although they were accompanied by the same rate decision. During yesterday's remarks, Powell reiterated the Fed's commitment to reducing inflation, even if it meant below trend growth and softening labor markets. I'm not really sure we got anything new after yesterday's remarks, but what investors didn't get was a sense of optimism that there was a clear path to the end of the Fed's restrictive policy in sight. Stock markets responded yesterday by finishing down 1.7%. At this point, the labor market remains strong and resilient, with unemployment and jobless claims remaining close to historic lows. In short, people are working, earning a paycheck, and able to pay their bills, making the Fed's tough stance somewhat, and I'll put an emphasis on somewhat, stomachable. But if the labor market began to falter, I'd be curious to see the Fed's response and if they'd be willing to soften their tone. It's been a tumultuous time for markets, and volatility is likely to continue until inflation is in the rearview mirror. Although the current climate is painful, it may be beneficial in the long run for investors and retirees to have the Band-Aid ripped off now, get inflation in check as quick as possible so that we can get to the other side of this economic climate. Thank you for listening. We value the trust you've placed in us during this uncertain time. If you or someone you value has concerns about the current environment, please give us a call. We look forward to hearing from you.